It's the investment trend that's been dubbed Wall Street's favourite four-letter word. A SPAC is a shell company set up by a group of sponsors who are traditionally well-known investors, private equity firms or venture capitalists. The SPAC then IPOs on an exchange and uses the IPO monies to buy a private company, which is then listed. SPACs are also called blank cheque companies because investors buying into the IPO don't know which is the eventual acquisition target. They're essentially writing billions of dollars in blank cheques to the sponsors. This structure was all the rage on Wall Street last year, accounting for approximately half of the overall IPO market. The trend has continued into 2021. SPAC IPOs have broken the record set last year, both in terms of number of issues and the proceeds raised. To broaden their pool of acquisition targets, SPAC sponsors are turning to Asia. According to Refinitiv, the number of SPAC M&A deals targeting Asia-Pacific companies hit a high in 2020, with 29 deals worth $2.3 billion. So far in 2021, there are only 2 deals, but the combined value of those deals is already $4.6 billion, the highest ever over the past decade.
There are quite a few technology-related companies across Asia as a region, with the reasonable size for those kind of SPACs to look at. And Asia still generally is a very good growth story. Of course, so there's interest in finding targets.
There are good businesses out there that deserve to be listed. It depends very much on the business owners whether they want to do so.
2 of Southeast Asia's biggest tech plays, Grab and Traveloka, have reportedly been approached or are targets of US SPACs. With no lack of good quality targets in Asia, it may even make sense for the region's bourses to list SPACs. The number of SPAC IPOs here have been in the low single digits in the past 2 years, after hitting a high in 2019. Here in Singapore, SPACs could be listed as early as this year.
SPACs have existed for a long time. They have not really destroyed value. So if there is really a need for a few SPACs to be listed in any part of the world, that will include Singapore, then yes, it should be allowed. When it becomes a generic instrument to be used as a quick money-raising opportunity, when people don't understand what it is actually meant for, the risk-reward, the players involved, the regulatory environment involved around these things, that's when you start to have a problem.
Regulators will say, look, yes, we're going to open to the retail, but here are my safeguards. What we see in the States, they already continue to refine the safeguards. One of the safeguards they fine-tuned in December last year only. So this time round is mandated that when you put on your prospectus for SPACs, at least in the US, it requires the sponsor to say, look, those I have succeeded. Yes, you can say, but please, you need to disclose those you have not succeeded. At the end of the day, it's willing buyer, willing seller, and full disclosure is certainly needed. I'm for SPACs to be introduced in Singapore.
Experts say one key concern over SPACs is the quality of the sponsors.
My research shows that SPACs whose sponsors are these famous people from the fields of music, sports, politics, etc., do not perform that well when compared to SPACs whose sponsors have held top management team positions at publicly listed firms. Those individuals who are or who used to be sportsmen do not have the necessary skills to run a SPAC and identify a good quality target. However, those individuals are very successful in promoting SPACs, building investor confidence, and swaying investors.
There is also a misalignment of interests between the SPAC sponsor and investors. The sponsor gets 20% of the combined entity if they can find a firm to merge with the SPAC within 24 months of the IPO. If they fail to do so, the SPAC will be liquidated the IPO proceeds returned to investors, and the sponsor ends up with nothing. Hence, a sponsor has a huge incentive to close deals, even at the expense of shareholder value. Year to date, Refinitiv data showed 84 SPACs have announced acquisitions with a combined value that has already exceeded 2020's numbers. Experts say more than 300 SPACs could need to do a deal this year. For the investor who's thinking of investing in SPACs, it may be helpful for them to know that there are two life stages of SPACs. Stage 1 is in the period from the IPO of the SPAC to the acquisition.
In the first stage, the investment has a downside protection. And investors get their money back if the SPAC does not find a target or if the investor does not like the proposed target. Recent research shows that investors in this stage 1 period, so between IPO and prior to acquisition, make about 9% annual return.
The problem arises in stage 2, post-acquisition.
When all these initial investors are redeeming, it really has an amplifying effect on those who buy the stock in the secondary market and then remain after the merger. Percentage-wise, the cost is going to go up. Then there's the warrants as well, which causes significant dilution. There's the promote, what's the referred to as the sponsors share, which is typically 20% as well. So if you add all of this up, and you look at who is shouldering all the cost, is typically actually those who hold the company through the merger.
The average annual returns have been negative and about minus 15%. So the risks really mostly manifest in that second post-acquisition stage.
SPACs are risky investments, but high risk also means high returns. And for the investor who's game for the risk, market watchers have this advice.
I do not think you can make an assessment like you would be able to make an assessment of a listed entity. So this is going to be at a higher risk level. This can be a fringe kind of investment. It can't be your main investment team. Don't do it as the first step before you understand all the risks and reward, right? And you have to go into this assuming that chances are that you don't make any returns. You might not even get your capital back.